very good morning. I hope everybody has rested well. And if you've had a chance to go through to the city, this beautiful city of Mumbai, a little crazy city, but it's a lovely city. I'm sure you must have enjoyed yourselves. We have amazing food and entertainment out here happening. So, definitely, if you get a chance, I know you'll have a very tight schedule, but if you do have a chance to visit the city, please do. Well, today is day two of the Conference of International Taxation 2023. And as usual, I would like to call on Mr. Mukesh Bhutani for the opening remarks before we start the session for today. It's the fourth session, and I will give you a little brief of that as soon as Mr. Bhutani is done with the opening remarks. Thank you.
Thank you, Jackie. Good morning, everyone. This is an outcome of our so-called hybrid. Our trustees first debated whether we should have hybrid or not. At the last minute, a decision was taken. And some of the people who attended yesterday preferred that they come hybrid, but we have quite a few people who have signed in. Good morning, everyone, and welcome to day two. We have four interesting technical sessions, and I'm not going to get into describing what each of the sessions are, but in terms of the relevance of these four technical sessions, considering the overall theme of the conference is important. Our fourth technical session and our first technical session for the day is on transfer pricing, and it has array of outstanding speakers which I will allow the chair and the panel leader to introduce. But just a little bit of background for those of who practice transfer pricing are fully aware of the landmark action point 8 to 10 of BEPS action, and more importantly, the relevance of the DEMPI functions. We've added another element to the technical discussion, which is the relevance of Pillar 1's Amount B proposal as it would play out in the context of action point 8 to 10, because I'm sure that when BEPS 1 came into existence and action points 8 to 10 and action points 13 were born, nobody envisaged that BEPS 2.0 will come in, which will bring in another variable, which is Pillar 1 and Amount A proposal. So the panel is going to debate. This panel is going to be led by Eric Mehta and Monique. Session 5 later today before lunch is going to look at the relevance of global developments in the context of treaties. This has key issues as we see on treaty interpretation as we move into a multilateral forum, not just in terms of MLI, which was signed in 2018, but the future MLIs, which will come in as a result of the two-pillar solution. It will identify the current trends on characterization of transactions, particularly technical services. And for those of you who practice in India, know how India pushed its agenda way back, almost 2 decades back, with the UN on expanding the scope of technical services, an item which is back on the UN list again. We are also going to examine the application of treaty and anti-abuse rules, particularly given the relevance in today's environment on application of principal purpose test, beneficial ownership, which has become a norm in the recent audits that we have seen. Some of our international panels are going to also debate on the static versus ambulatory interpretation of tax treaties, and that debate has gathered momentum after the recent Supreme Court decision in MF1 case. Rachel Saw, who's going to introduce our panel, is going to take us through the highlights of session 5, which is before lunch. Immediately after lunch, we will move on to session 6, which essentially deals with emerging technologies, challenges, and prospects for tax advisors. We are going to have Liz Chen participate from United States. This session is going to be led by Parul Jain. Given all the monumental research work that Nishit Desai Associates as a firm has done, we couldn't have found a more appropriate panel to lead. Parul, thank you very much for that. Our last session is session 7, which is going to look at the emerging global landscape and overview of the Indian position. This is just to be able to round off the entire 2-day proceedings. It's going to be led by Mr. T.P. Otswal, our trustee, and Sanjay Tolia, with again an outstanding panel. We hope to be able to finish our proceedings before the allotted time, which is 4:30. Otherwise, somebody's marriage will get delayed. Somebody's getting married in this hall. So I just request all of you to be on time. So with that, over to you, Eric. Thank you very much.
Hi, good morning, everyone. I have the pleasure to firstly introduce my fellow panelists on the call on the dais today. Mr. Rajat Bansal, he is currently the Principal Chief Commissioner of International Tax based in Delhi, heading all the international tax transfer pricing, APAs and DRPs. He's also worked in CBDT in various capacities, including as the Joint Secretary, FTTR, and was a competent authority for various treaty negotiations. I mean, he has to be accredited with the amendments to tax treaties with Mauritius, Singapore, and he's handled several MAP and BAPA cases with Japan, Australia, China, South Korea for over 6 years, with him also heading the overall MAP team. He won the OECD award for 2019 for the highest resolution as well. He was India's single point of contact for multilateral convention to implement tax treaty related changes due to BEPS, MLI, Global Forum for Tax Transparency and Exchange of Information, Forum for Harmful Tax Practices, etc. He was a member of the UN Tax Committee on Cooperation in International Tax Matters in his personal capacity and as an expert from 2017 until 2021, where he significantly contributed to the UN manual model updated and the transfer pricing handbook revision, along with the dispute resolution handbook as well. He is a member of various working groups and committees constituted by CBDT on topics such as indirect transfers, APAs, safe harbors, etc. I also have my panel chair, Monique. She's an extremely experienced transfer pricing specialist with over 30 years of experience, having worked in various capacities. She was the global transfer pricing and EMEA tax controversy lead at a very big four accounting firm, worked with the IRS in the APMA team, and has served as an advisor to the US competent authority while in the office of IRS as Associate Chief Counsel International. Monique contributes and has advised the UN Tax Committee since 2010 and is a member of the UN Transfer Pricing Subcommittee since its inception. She is highly recognized as a tax disputes lawyer and is a highly regarded transfer pricing practitioner, something as recent as ITR World 2022. Monique also uses her experience to educate the next generation of lawyers and has been teaching transfer pricing at various leading universities throughout her career. Anushka, who's going to be our speaker for today, she's a deputy director of the Knowledge Center at IBFD in Amsterdam, and she's the manager of VAT transfer pricing and specialist knowledge group of IBFD. She has many years of experience in international tax, of which 17 have been dedicated to transfer pricing and tax risk management. She's also responsible for a lot of transfer pricing courses offered by the IBFD. She's published over 40 articles and chapters on transfer pricing, tax risk management, and tax technology, and also is a regular speaker at transfer pricing conferences around the world. Shikha is currently the South Asia head of tax for Unilever. I mean, she's a chartered accountant, holds a master's degree in finance from the London School of Economics and Political Science. She's got a mixed bag of experience, having worked both in the consulting sphere with firms like Arthur Andersen and Deloitte, and also with large companies such as GE and Novartis before her current role. She contributes professionally very often as an author and a speaker on a fora of topics ranging from international tax to GST. Last but not the least, Vijay. He's the national transfer pricing leader for EY India, having been with the firm for over 32 years, largely instrumental in helping their clients design their APA and dispute resolution strategy, and helping them negotiating the APAs and maps. Of course, he's also a co-author of various books that have been published over a period of time. Uh, Without further ado, I'm just maybe 30 seconds for myself. I'm a transfer pricing practitioner, having been with the firm with PwC for almost 10 years. I lead the transfer pricing practice currently in PwC and really happy to be here today. I'll take a few minutes to briefly talk about what we plan to cover as part of this panel, and then we'll have a very engaging discussion. We'd also like questions to come in, so if you would prefer, and given that we are running a bit behind time, if there are any questions, you can send them over to the panel. We'll try and address them as many questions as we can in the time that we have. So today's topic is practical considerations for Indian businesses when we're looking at transfer pricing. Now, transfer pricing in India has evolved over a period of time, right? Especially because industry has evolved. The way companies operate, the business models have evolved over a period of time. And so has our overall the way transfer pricing, while the law may not have changed significantly because there is that much to do, that you have to have transactions at arm's length and you need to have documentation which justifies it. But what is arm's length? What is the right documentation that justifies it has, of course, evolved over a period of time. And my own belief is it can be as subjective as one can think of it to be, because what may be a right price for me may not necessarily be a right price for someone else. And especially when it comes to revenue, they may have a different kind of thought process on that. Over a period of time, we've seen commentaries kind of evolve where they're giving more direction in terms of what a potential interpretation could be. We saw a major change. I mean, the BEPS chapter actually started in April of 2013, but it's only in October 2015 when the BEPS action plan 8 to 10, particularly dealing with transfer pricing on intangibles and value creation came about, is when things started being looked at a lot more closely and seriously. We've seen changes again happening in terms of how administrations have taken to the BEPS action plan. We've seen changes in the documentation with the BEPS action plan 13 as well, right? In India, the issues have evolved over a period of time. When we started in 2002, the first few years were largely on comparability analysis, whether it's our comparables, which were there in the TP documentation, versus comparables that the tax department could come up with. But that's, again, that landscape has significantly changed over a period of time. The whole context of the way issues have kind of grown, right? You had comparables, it moved to disallowances of payments such as royalties, intra-group services, and we'll try and touch upon it time permitting. Then the whole, the circulars which came in, then they were rescinded on what constitutes contract R&D, who owns those intangibles. Those have evolved over a period of time as well. Now, intangibles is as vexed an issue in India as it has been in any other part of the world, right? Because the whole concept of an intangible is something which you can't touch or feel, but is there to kind of realize. And the true test, one of the true tests they say is, can you manage it? Can you control it? Can you own an intangible, right? Now again, the disputes on that have been there ever since transfer pricing laws have been around, not just in India, across the world. And it's certainly not the end of litigation as I see it. Just dwelling a bit more on intangibles, we've got things such as DEMPI, which is again what has evolved over a period of time on what can be interpreted as DEMPI and who really runs those functions. We've got issues which have now started going right up to the Supreme Court because again, taxpayers have litigated what they believe were not necessarily the right outcomes from a transfer pricing perspective. Marketing intangibles is one such issue. We are awaiting, of course, what's going to come out in the Supreme Court. Now, whether the Supreme Court is going to enunciate everything on what the marketing intangibles is about, or is it going to kind of give a sense as to what principles need to be looked at? Is going to be a very interesting proposition as far as I see it. The other area, and again, conscious of time, so not going to touch much upon it, is in terms of the amount B that Mukesh was alluding to. We've got the draft that came out in July, which talks about some of the propositions on what can be covered, what should not be covered. There are various intensity tests which have been laid out. Now, I started by saying that transfer pricing can be very subjective. I genuinely believe that the draft in its current form will only add more to the subjectivity element which is there. We'll try and discuss a bit more about that in terms of the coverage, etc., time permitting. Last but not the least, the recent Coca-Cola judgment, I know it's not that recent, it was 2020, but some of the principles that came out of that, I genuinely believe hold true for what transfer pricing stands for over a period of time. And I'm sure most of you would know, but the way the whole judgment came about, where there was a strong dispute between the way a taxpayer went about arranging their transfer pricing affairs, not getting too much into the factual part. But some of the principles that came out was your functional analysis and actual conduct, something that we've been talking about it for many, many years, at least in India, ever since transfer pricing came about, that your FAR as you document and your actual conduct can't be too different. So there was a disconnect that the court felt was there in that case. The substance in terms of economic ownership versus legal ownership, merely funding an IP does not mean that you really own the IP. They have reiterated that. But at the same time, they have kind of disputed on what the taxpayer believed was the economic ownership lying in the overseas subsidiaries versus what was lying, and the whole construct of how the remuneration model was kind of structured. I am not. So those are things that, as Monique said, I'm not giving it away. We are going to kind of cover that briefly in our session today as well. But looking forward to a highly engaging session. Please feel free to, as I said, send over your questions. We'll try and address as many questions as we can today. So thank you once again for being there. And I hand it over to Anushka to take us through the next part.
We'll leave some secrets in the discussion. There we go. All the way at the
We need to go back.
all the way at the beginning, please. There we go.
Okay, thank you for the introduction, Eric. And he already indicated like some items that he would address. And what do we see? The world has been changing fast and will continue to change even faster. Many developments have impacted and are still impacting intangibles and transfer pricing. Throughout the years, and the importance of intangible assets has increased. Business models of companies nowadays highly depend on intangible assets. And it only shows from the rise of IPs and, for example, the number of filings of patents and trademarks. Digitalization and globalization are changing, and the relevance of presence as a nexus for the levying of tax, given that a lack of physical presence would normally prevent the levying of corporate income tax. Meanwhile, the global tax community embarked on BEPS 1.0 and then continued with BEPS 2.0, and consisting of two pillars. Remote and flexible working went mainstream as people became comfortable and productive working remotely from homes. Many companies soon realized that they could achieve the same levels of productivity and value creation at substantially lower cost, before even considering the added value of being able to access global talent pool by becoming 100% remote. So if we look at BEPS 1.0, the purpose of BEPS actions 8 to 10 was to align the TP outcomes with value creation. The concepts introduced in BEPS actions 8 to 10, like the SAP's control of risk framework, for analyzing transactions involving intangibles, and DEMPE functions are now core to the practice of transfer pricing. The exercise of control functions over the relevant risks and the performance of the DEMPE functions have become a central nexus of the existence of a taxing right over the profits that are generated by intangible property. The absence of part of these criteria, for example, the maintenance of the protection of an intangible, would weaken the nexus and lower the taxing rights of a country. But while dealing with transfer pricing and intangibles, it is also good to bear in mind some other questions. Is it really an intangible that we are looking at? Or is it something else? Maybe an inefficient supply chain? Does the transaction entail different segregated transactions, or is it so entangled that it should be considered an integrated transaction? Does brand sell the product, or does product and technology sell the brand? And if we are looking at DEMPE, and DEMPE functions are performed by different group members, how does it pan out? And what is the influence of remote and flexible working? Several countries around the world have expressly incorporated the DEMPE concept in its analytical framework into their legislation. Manuals, decrees. Examples are Australia, Germany, and the Netherlands. Some countries have a different approach. For example, Sweden. They did not incorporate the explicitly refer into their Income Tax Act to the OECD transfer pricing guidelines. However, Swedish case law refers to the transfer pricing guidelines and gives legal basis to apply the OECD guidelines, including those incorporated on the BEPS Actions 8 to 10. The Swedish tax administration targets quite some local activities, such as marketing and distribution activities, local manufacturing, and local research and development. Other tax administrations followed a different approach. They even applied the new concepts, DEMPE and control over risk concepts, on previous cases, even before 2015, so retroactively. The notion of marketing intangibles, which would relate to an economic rather than to a legal approach, is not recognized under French rules. In practice, however, the tax authorities tend to take into account within tax audits some kind of economic ownership of intangibles, where, for instance, a French distributor incurs significant marketing expenses, which may lead to a high return on sales from the point of view of the tax authorities. The French tax authorities are quite active in the field of transfer pricing, and notably also on royalty payments. A different approach is taken by Denmark. No particular guidance on intangibles for transfer pricing purposes. However, they publish the guidelines on the valuation of businesses and intellectual property. Interesting cases are Adecco and Pharma Distributor. And last but certainly not least, the US. Interesting cases are the Coca-Cola case, Amazon, Medtronic, and Veritas. We'll not deal with all of them, but Amazon was really focusing on the definition of intangibles. And there was a bit of like a restrictive approach taken for the definition. Veritas concerned the relevant question concerned on arm's length valuation of buy-in payments with respect to a CSA. And for the valuation of the pre-existing intangibles, these could not be valued using a perpetual life assumption. Interesting enough, the IRS launched a new initiative focused on large foreign-owned transfer pricing, foreign-owned inbound and distributors. So basically looking at distributors who have a low margin or consistent losses. They will actually receive nudge letters to actually have like another look at their corporate income tax returns from 2017 to 2021. The timing is interesting, taking in consideration the Amount B developments. And this is just a selection of cases and approaches. And while dealing with transfer pricing and intangibles, but also transfer pricing in general, it is always important to keep an eye on the customs. Customs and transfer pricing are different animals. Different methods are being used, but it's very important to keep an eye on the customs valuation. It's also important to make sure that from a customs perspective, the price is not being influenced by the relationship of the parties. And for customs, it is important to bear in mind the circumstances of sale tax. In addition, it is also important to keep an eye on the definition of royalties. You can actually put calling something a royalty payment. It does not make it a payment for customs purposes. Hence, it is always very important to keep an eye on the domestic legislation, whether a royalty is being defined in the customs legislation of a country. And if a payment is made for a royalty for customs purposes, it does not automatically mean that it is dutiable, that it should be included in the customs value. And that actually brings us to three conditions. The royalty payments should not be included in the price actually paid or payable, relate to goods being valued, and be paid by the buyer directly or indirectly as a condition of sale. Some of the panel members will address this. And then we actually are faced with looking at the DEMPE functions. And the panel will actually deal or address some of the issues they face and challenges they face when applying this DEMPE concept. So now let's move to the marketing intangibles. Marketing intangibles have been a key focus area in India. The Indian tax authorities generally challenge any significant advertisement, marketing, and promotion expenses incurred by the Indian entity, especially where such entity is using marketing intangibles legally owned by an overseas company. On the screen, you see several cases. My panel members will discuss them in more detail. But what you see on the screen basically shows that views differ on whether A&P expenses can be considered as or should be considered as an international transaction, and whether BLT, the Bright Line test, should be applied or not. As indicated, the panel members will deal with this in more detail. So let's move to Amount B. Amount B applies to qualifying transactions, and the qualifying transactions would be buy, sell, marketing, and distribution transactions, and sales agencies and commissionaire transactions, focusing on relating to wholesale distribution. So retail, business models, provisions of commodities, non-tangible goods, and services are outside the scope of Amount B. There is some good news. The first consultation draft concluded or included 12 quantitative and qualitative criteria to be covered under Amount B. And the new consultation draft only concludes or contains 4 criteria. So that's one on a positive note. Outstanding issue or question on the table is whether Amount B should also include additional qualitative criteria. So we have a version, Alternative A and an Alternative B. And the countries that are in favor of Alternative B would actually limit or add additional criteria in order to limit the scope of countries, of companies that would fall within the scope of Amount B. The heart of Amount B is the pricing matrix, which would determine the returns on the marketing and distribution activities. Consists of 2 dimensions, industry grouping and factor intensity. And the industry grouping shows, there are 3 of them, that there are quite some industries that fall within the scope of Amount B. So what does it mean for the taxpayer? And what can the taxpayer do? Well, they could already look at the activities that are like the business operating, whether they are activities concerning limited risk distributors, commissionaires, sales agents, and whether they actually fall in scope of amount B, as it is drafted as it is now. Interesting is also to look at the APAs, existing APAs. Are there existing APAs covering distribution and sales agency activities? Would you want to renew the APAs, or would you want to file a request for a new APA? And if the group is considering a business restructurings, how would that pan out under amount B? So let's move back a little bit to the AMP and what it means for the approach of the Indian tax authorities. Would the Indian tax authorities actually be willing to apply amount B, and taking in consideration the approach they have taken so far with the AMP expenses? And with that question, and also with the questions on the slide, I gladly hand over to Monique and to the panel.
Thank you very much, Anushka. Appreciate that. So, ladies and gentlemen, if you listen to the presentation of Anushka, she really points out that, you know, from a transfer pricing perspective, what jumps out as a challenge for us in business is intangibles. How are intangibles dealt with? You know, they are intangible, which is a start. Who owns them, and what is their value, and where is the value generated by the intangibles allocated? Now, since we're talking about practical considerations for Indian business today, I have the fantastic panel here that can give you some insights on that. I do want to make one observation. People are speaking in their personal capacity. They're not speaking as, this is what Unilever thinks, this is what the government says, this is what EY says. You know, I'm just gonna, it'd be nice if we can brainstorm a little bit and we're not tied to this as like, but there, you said, that means, you know, this is etched in stone now. I think we can think out of the box about what are the facts, what is the reality, and where could it go, and where should it go. So that caveat I do want to put out. You know, these are the questions that we were left with by Anushka, and thanks for that. I think we'll try to chew on those during our presentation. We have a couple of practical considerations that we are going to look at. And I think the first thing you need to know from a business perspective is, so what is the experience of government, and what would the government expect and want? And from you know, the only way to find out, you know, where things can possibly go in the future as we discuss this is, what are the personal experiences and observations of somebody who's been very close to the fire on what's been happening at that site. So Raja, with that, maybe you want to give an introduction on the value of intangibles as you've seen it, and as you've seen it progress, and as the importance of intangibles, and what you personally think about that.
Thank you very much. Thanks, Eric, for the introduction and setting the tone of this session. Thanks to FIT and Mukeshji for convening this conference after a gap of 4 years. And I have been here many times, and this is a very important conference, probably the best conference in India on international tax and transfer pricing. So the topic for today, practical considerations for Indian businesses. So we are, it has been identified that focus is on intangibles. So let me, before giving you the position of generally followed in the Indian tax administration on the transfer pricing relating to intangibles, I'll give you kind of a background. So transfer pricing of intangibles has been a difficult area of work for tax administrations across the world, as we all know. Situation has been the same for Indian tax administration. Now, more and more intangible related cases are there for us to examine and decide, but and therefore there are multiple challenges in this area. Now, why are the transactions involving intangible assets are difficult to evaluate? Intangibles are rarely traded in the external market, and it is very difficult to find comparables in the public domain. That is one. Now, intangibles are often transferred bundled along with tangible assets. It's not a standalone transaction. So, and they may be difficult to detect. So, these are some of the issues which are overarching and are important for the transfer pricing relating to intangibles. Now, we are coming across ALP determination of royalty payments as well as receipts, ALP of determination of ALP of transfer price of intangible in respect of transfer of intangible, and lastly, the most prominent issue relating to AMP, which Anushka highlighted in her presentation as well. What is the issue regarding the AMP expense? Uh, Let me summarize the background. This has been going on for quite a bit, as all of you would probably know, but just for the benefit of those who are not so much familiar with this, I think it was, at least it is a decade or more than a decade old controversy or an issue. So what happened is that expenditure incurred on marketing functions has been considered for adjustment by Indian tax authorities on the premise that the taxpayers were incurring these expenses on or behalf of the parent companies outside India, and these expenses promoted the brands or trademarks that are legally owned by the overseas associated enterprise. These expenditures created marketing intangibles in the form of brands, customer lists, dealer distribution channels, etc., even though the Indian company may have had no ownership rights in these intangibles. So that was the essence of this. And based on this premise, it was held by the Indian tax authorities in cases that the functions carried out, which are in the nature of development of relevant comparables, development of the intangible, deserved compensation. So for that, they applied something called a bright line test, and based on that, an adjustment was made. Functions relating to development, enhancement, and exploitation of marketing intangibles, now termed as DEMPI functions, under the BEPS report, result in two kinds of benefits for the AEs. Firstly, there is a direct benefit by way of increased revenue from the territory, Indian territory. Second is indirect benefit, that sales by AE in the Indian territory directly by AE increase. And lastly, there could be enhancement of the exit value of the intangible. So, as I mentioned, there were cases done in India made on the basis of bright line test, and thereafter litigation followed, and there have been number of cases, prominent cases which are worth looking at, and which I just mentioned are the ITAT decision in the LG Electronics case, and two Delhi High Court decisions in Sony Ericsson and Maruti Suzuki cases. So there are a number of things said in these cases. In fact, if you read them, it's a kind of a very long, very numerous issues dealt therein. But some of the issues which I picked up for pointing out, and which will be probably, all this I am citing to come to the final position or what is being done in the Indian tax administration at the moment. So in Maruti case, court held that existence of international transaction has not been established. So court said that since AMP being international transaction has been inferred on the basis of bright line test, it is not valid. On other hand, in Sony Ericsson case, the court rejected the contention about AMP not being an international transaction, mainly on the ground that the declared price of international transaction included element of AMP expenses for which they stood duly compensated in the margins or the ALP. Rather, as in said in Maruti case, the Sony Ericsson, there was no dispute and the taxpayers had not challenged as per the decision in Maruti case. Now, in Sony case, court also gave a finding that in view of another issue was that, which has been settled probably, that there is no international transaction reported. So actually, there cannot be any exercise of undertaking to find out the ALP. So court in Sony case gave a finding that in view of retrospective amendment in the law, TPO is empowered to adjudicate on transactions which have not been reported by SSE in his documentation. I don't think that issue is any longer very significant and it has got settled, but at that time it was an issue. Now, in Maruti case, court held that even if it is found that there is an international transaction, there is no machinery provision in chapter relating to transfer pricing which enables determination of fair compensation to the Indian entity. Court termed application of bright line test as a quantitative adjustment, which may be contemplated in taxing statutes of certain foreign countries like US, Australia, and New Zealand, but not in Indian law. Court held that for an international transaction, there has to be an arrangement or understanding or action in concert. So this they picked up from the definition of transaction in law. And BLT did not find favor with court in Sony case 2. Court held that where comparables adopted by SSE as a bundled transaction using TNMM had been accepted by the TPO, it will be improper to treat AMP expenses as a separate transaction. That's what the court held in Sony case. Then there were some peculiar aspects in Maruti case due to which probably some interpretation is done vis-a-vis manufacturer, vis-a-vis distributors cases. In Maruti case, court held that Maruti was already a well-established brand in India since 2002 and significant AMP had been incurred by the Indian entity by the time Associated Enterprise acquired controlling interest in Maruti Suzuki India Limited in 2002. The products carried co-branded mark Maruti Suzuki. Also, Suzuki Motor Corporation's worldwide AMP spending was 7.5% of its sales, whereas MSIL spent only 1.87%. So therefore, they found that it's not correct to say that MSIL in any way is contributing to the brand building of Suzuki brand. Now, matter is presently before the Supreme Court, and as we all know, we are all awaiting the decision from the Supreme Court, and till then, cases are still going on, and because now what happens is that a legacy is created in terms of the general practice for the litigation, and those are followed in other cases, and that particular case till we get a decision from the Supreme Court. So still, the way we are handling it in the tax office, certain general, I will just point out some certain aspects in general. This may be varying from case to case, but in general, we can say that this is what is being done on the AMP or marketing intangible related issue. So a finding is attempted to be given on existence of an international transaction on facts of the case. Now, that is being done because that's kind of a jurisdictional requirement, and that is what the TPOs are doing. Then where TNMM is found to be the most appropriate method, intensity of AMP functions of the taxpayer are compared with that of comparable entities by comparing their respective marketing and related expense as percentage of revenue, and only after the appropriate adjustment, the operating profit ratios of the comparables are compared with the operating profit ratio of the taxpayer. In manufacturer cases where interconnected international transactions are present, that is royalty payment or purchase of raw material, etc., then after establishing existence of international transaction, AMP expense and royalty payment or any other transaction could be seen together. So broadly, this is the approach that is being followed at this stage when the matter is sub judice, and we have not, there may be other variations. I'm not covering everything here, but this is in general what I feel is being done in our offices all across the country. Now, the one issue was, what are the avenues for dispute resolution and avoidance in this area? So there are a number of cases pending, and then in the court and under litigation at various stages. What will be the outcome? No one knows. So at the same time, there are cases where an attempt has been made both from the side of taxpayers and the tax administration to find a way out. So the progress in this area is under the APA program. And APA program, as we all know, is a very prominent program in India. 500 APAs having been concluded, 97 or so bilateral APAs having been concluded, where tax certainty for 9 years is achieved, 5 forward years and 4 backward years. And there it's a collaborative approach. The tax administration and the taxpayer come to a conclusion on various aspects of the matter, and maybe they are not fitting into the exact decisions by the courts where two sides have different views. But at least for that particular case, convergence emerges and the two sides can come to a conclusion. So in that direction, I think we have concluded a few APAs, more of unilateral APAs than the bilateral APAs. And I remember that with Japan, we had a AMP issue map pending, but it could not move forward because the competent authority of Japan was firstly wanting to settle the issue of international transaction, and they were not ready to move forward. And that could be a situation in many cases. But if one is willing to move beyond that, then probably there is a way out. And in APs, I am told that in one case, the map relating to AMP has been resolved with another country. And similarly, maybe there is an option there to settle this matter under map. I'll just tell you what has been the kind of unilateral APAs done for AMP. So in one case, for distribution segment, RPM was applied, and for identified AMP brand building cost, reimbursement with markup was agreed. So this was one case. Then in some cases, royalty payment was adjusted, meaning thereby that AMP and royalty payment together was seen. And it was agreed that the royalty payment is cross contributing to the AMP compensation, and the AMP compensation and royalty payment taken together will be what should be seen as flowing from the AE, and then it was resolved through that route. And in a manufacturer's case, OP by OR, which was the PLI in that case, was increased slightly to cover this transaction, and it was agreed between the two sides that the matter can be resolved like this. So at the end, I'll say that probably it's probably a good option to follow the APA route, and till the time it's resolved by the courts, and see if tax certainty can be achieved in various cases.
Well, that's very encouraging. Thank you for that information. I mean, we hear that all the governments, based on the cases that Anushka pointed out, we get an understanding that governments in all countries are grappling with this issue and are looking at base erosion through payments for intangibles. But it sounds that true litigation and true developing a position, at least in the Indian market, there's an attempt to get to agreements on this particular issue, and marketing intangibles being one, but intangibles is broader than marketing intangibles, but that being one. Now, Shika, you are in the midst of this because, obviously you operate here in India, but you're dealing with the world, right? And so what here, I mean, we've listened to the India-specific position on marketing and avenue for dispute and avoidance and resolution here. What are issues that business sees in the field of intangibles, that are relevant of concern, and, how do we tackle this? How do we steer safely through this?
So I think Rajat sir explained very, very beautifully, and there's no denying that the AMP issue is certainly the elephant in the room for most inbound multinational companies that are either purely just distributing in India or manufacturing and distributing. And assuming it's an international transaction, I think the real challenge lies where corporates are unable to take a path forward because there is no consistency or harmony in the approaches taken by the courts or the approaches that Sir just described on how the APAs could get resolved. And I think fundamentally some of the things are still not addressed. Fundamentally, I would think that is the marketing efforts that are being undertaken by the Indian company, are they contributing to development of an asset? And therefore, should they be valued on basis of value, which the Indian business will get at the time of alienation of that asset globally? by the parent, alienation of the legal ownership. And that's when, as part of the purchase price allocation, the Indian entity will also get compensated. And that alienation may never happen, which means the Indian entity may never get compensated. Or is it a service being provided towards brand enhancement to the parent, which then becomes a cost-based proposition, where the Indian entity needs to be compensated based on cost? And I think Sir alluded to that, that in that case, the courts are asking the question, is it an incidental service or is it something that the global entity actually asked for? Because one has to then do a needs and benefit analysis from the global side. Or is it just a comparability difference? So I think there are three approaches potentially out there, which will determine the timing when the payment becomes due to the Indian entity. The characterization will determine the basis of benchmarking and compensation. So it's really out there, and ultimately, I really think because this is inevitable. This dispute, I mean, once you start operating in India, it's inevitable, and given the court certainty still not happen, an APA or a MAP is the best way forward. The question is, what is the outcome that an APA or MAP will yield is very transaction, very business, very company specific, very fact specific. So there is no way to predict what you're really going to get. But that is the only uncertain way to gain certainty. I think the other big area on intangibles where for sure there is a dispute, many a dispute, is on royalty payments, because a lot of Indian inbound MNCs, the Indian entities paying royalty either for technology or trademark to the foreign owner. And the question is, what is the right rate of royalty? Should a royalty even be paid? Is there a benefit? And there are again two views out there to say, for a royalty payment, is it somewhat different from a service? For a service, the Indian entity might have to demonstrate that the service has been received, that there was a need for the service. But for a royalty, is it just not access to the IP? Can one really question that that access should be justified? The payment for that access should be justified because of some incremental or continuous new benefits coming the way of Indian entity every single year. Because every single year, there may not be a consistency in how much benefit is received by the Indian entity. So the need and benefit for royalty payments versus an intragroup service, I think somewhere the courts are unclear and there are conflicting judgments. Benchmarking, Rajat sir also alluded, very, very difficult. There are hardly any data sets. There are hardly any databases that can allow us to have a comparable benchmark. And I think things get a little bit more operational when one talks about staggered royalty rates. So to say that royalty rates will increase from X% to Y% in 2 years and Y% to Z% in another 2 years, how do you justify that rate increase? Does it mean something has fundamentally changed on the ground in terms of more benefits or the trademark or the technology becoming different? And again, I think the answer here in my personal experience lies really going through the AP or the MAP route, because that is the only effective way today that can solve it. I think the third bit on intangibles, which in my personal experience I've faced a fair few times, is transfer of intangibles. The whole question of valuation, I think Indian courts have largely aligned with OECD that discounted cash flow is an accepted method. But the discounted cash flow itself is made up of so many variables: the growth rate assumptions, the discounting rate, market size, that by the time the assessment happens, it is possible that the administration could have a look-back approach or have the benefit of hindsight, which the taxpayer did not have at the time of doing projections. And I do know that there are 2 tribunal judgments which have held that the ex-post analysis is justified as opposed to the ex-ante approach that the taxpayer had to adopt because there was no choice available. And that's a very tricky one because, again, OECD mentions about the fact that the actual results can vary from the projections because of unforeseen factors, COVID being one, let's say, but there could be other factors other than COVID as well. And, excuse me. And therefore, and I think OECD also talks about that as long as the actuals and the projections, there is difference does not exceed 20%. I remember reading that some time ago. I think that is supposed to be a fair range, but whether Indian courts are going to accept that, and I do think there's a lot of litigation that still happens on this. So I think intangibles are a ground which is, I mean, any transaction, either a royalty or an alienation or economic ownership, a marketing strategy is fraught with challenges, and I think one should only expect litigation unless once the companies decide to go for an APA. So that's where I really think, Monique, on intangibles, to a specific question, there are a bunch of challenges. Unfortunately, not too many solutions. But I do think there's a lot of active thinking within the administration. There's acceptance of APAs. They're getting resolved, but they're very case specific as well.
I mean, there's a lot of corporate hygiene in this area that can be followed as well, right? I mean, one is like, how do you treat expenses? How do you treat your expenses? Are they just deductible expenses, or are you capitalizing them? If you're capitalizing them, you're creating an asset, right?
Yeah.
And if you're deducting them, then it could be just an operating expense for being in the business. Now, every distributor of a product will have to, one way or another, market the product because, chances are your consumer is not going to walk into your office without you showing that your product is superior or competitive. So this is where we're grappling with, how do you treat those expenses? What proportion of your operating expenses can be A&P, and how can you justify that? But also as to royalty rates, maybe one question is, obviously everybody wants to have one royalty rate for the whole world, because it's the same technology or IP that's being used. But maybe you really have to work on substantiating that for each market, whether that royalty is sustainable. So the attention you pay to that, which you would pay in an APA, explaining that to the authorities and saying that this is where it justifies, that's something that doesn't always come naturally in business in all area. And since this is such a sensitive area and one that's kind of left after BEPS 8 to 10, as Anushka put out, tried to tackle abusive royalties or IP structures, I think this is where we still have a ways to go. I just want to make sure, Roger, did you want to interject? Because I think you had no, you didn't. Okay, I was wondering what was the issue there. But that's something that we maybe jointly can consider, that we could work on. And this gets me to Vijay, advising on this obviously is not easy, right? I mean, you have to actually walk a very thin line along this on where to go. What is it? What you see? What you recommend? What the challenges are, particularly here in this market? Again, we're looking at Indian-specific observations that you would want to bring to the table.
Sure. Thanks. Good morning, everyone. So when it comes to intangibles, I think we still rely a lot on Action 8, 9, 10. I think that is, if I may say, the Bible for how to look at intangible transfer pricing. And there are derivatives of that in our court cases and how it has been used. And if I may look at it in two baskets, if I look at the marketing intangible part of it and the hard to value intangibles as two different buckets. The marketing intangible answer, we've kind of, if I may say, settled down in the India system to a great extent, looking at the Sony Ericsson case. So Sony Ericsson is a balance between the revenues view and the taxpayers view. The revenue view being that all companies who have AMP have an international transaction, and therefore you apply a bright line and any excess expenditure has to be reimbursed, howsoever profitable you are. So that is the revenue view that it used to be till it evolved thereafter, but that was the original view. And then the taxpayer view was that I spend for my own reason and you can never question me. So that was the other extreme. And then we had a fact pattern somewhere in between when this was all evolving, where there was a foreign company which had an Indian subsidiary. It had a brand that was registered overseas, and the Indian company was, allowed to use that brand, and no one else in the whole world was using that brand in that whole group. India just picked up because they just liked the name, and they used that brand for 20 years, and it became extremely valuable. And at one point in time, they said, why not buy out that overseas brand and make it an Indian brand? And a valuation was done to say what was the value of the brand today. And it came out to be an exorbitant value because it was profitable and highly profitable for 20 years. So there's a huge valuation. The question that came up was that should that entire value be paid to that foreign company for the legal ownership, or whether a part of it should be paid considering the fact that India has contributed to it over 20 years. The foreign company just registered it and did nothing for it. And I think that is where the problem statement came out more explicitly to say that, is legal ownership everything? And then the answer was no, you have to give enough credence to the people functions and the strategy. And this was all pre-BEPS. This was in the 2012 timeframe. As APA started, people started engaging with APA. This came out that you just and APA was also 2012, 2013 when it started. So all of this started getting into discussions at that stage, and even pre-BEPS, India started looking at it, saying that you just can't leave everything for legal ownership. You have to consider economic ownership. And there was the old OECD draft paper on intangibles, which said a lot of things that 8, 9, 10 said. So therefore, there was good literature available to rely on. And then we had the Rangachari report in the context of contract R&D, again, laying a lot around decision-making and how intangible related returns should be accruing to people where you have the strategic decision-making. So given all of that, we have now got to this Sony Ericsson position, which says that you just can't make it one way or the other. There has to be a semblance of reasonableness in that. And you also have to give value for people functions. You have to, which is not entirely done in Sony Ericsson, but I'll explain that. But it has dealt with it to say that you have to give some value for the expenditure being made locally. There is an incidental benefit, and we try and monetize it by looking at the TNML. So Sony Ericsson classifies companies into 3 buckets. The first bucket is service providers who are not distributors. They should get fully compensated because they gain nothing. A limited distributor should get a reasonable profit, which is the net margin for a distributor, along with an additional margin for the additional functions performed in respect of A&P. And the third is risk bearers, who may have no guaranteed profit. They do all the DEMPE functions locally. Now they have a potential intangible creation locally. The marketing intangible should ideally belong locally. It is not an intellectual property that can get registered. It is not an intellectual property that can have capitalization in the books as per accounting. It is, if I may call it, a deferred revenue expenditures. You do expenditure, but you will earn income over a period of time. So it is a revenue expenditure for accounting purposes, but it is a deferred revenue expenditure. So given the accounting standards, you can't capitalize it. So it just goes in as revenue, and for tax also, it's a revenue expenditure. But then you have the enduring benefit for the risk bearer. So if it's an Indian subsidiary which is listed and has its own head and brain, decision-making, independent board, it decides how much to spend, how much to, where to spend, what kind of strategy it should impose. It should get the rewards. The reward could be over a long period of time. It doesn't have to be profitable from day one, but you necessarily have to have the head and brain here. So you can't be a limited risk loss maker which doesn't have head and brain, and you say that they are a risk bearer. That will be wrong, because we have moved away from the whole concept of contracts determining where the risk is. So risk will be where the people are, again, borrowing from Action 8 and 9. So the people in India, if they decide how to spend, their KRAs, their appraisals are dependent upon the performance of the Indian company, and they're still loss-making, and they suffer in that process. You should value that, and it should be loss maker and doesn't need to get compensated on a real-time basis. But it is creating an intangible value. The intangible value that gets monetized is in the form of the distribution agreement. So again, it is not that when that brand gets sold globally, you have to share the reward for the fact that expenditure was done in India. You will share it when you terminate your distribution agreement. So when the IP is sold overseas, and if the distributor continues to be the same Indian company, the Indian company can continue to be a risk-bearing distributor, can continue to monetize it. It doesn't need to get any compensation because you still will keep earning the money for the distribution function. But if you're terminating the distribution agreement, then the exit charge point comes in, as Sir said. There will be an exit question as to what is the compensation for termination, which will be a value of the intangible that you created. So that has been spelled out, probably in brief, in Sony Ericsson, but it has touched upon the three baskets of companies, and you have to distinguish between companies into one of these baskets before you look at them. So we have a fair idea of what is the right answer. Maybe we don't get the same reaction in a TP audit, and we go through litigation. And unfortunately, the matter in the Supreme Court is very, very limited. The questions are very limited. It doesn't go into that level of depth. We don't have companies with the three fact patterns fighting that dispute. Largely, the dispute is around whether it's an international transaction or not, which is a pure Indian law question and not a OECD or economics-based transfer pricing question. So that still remains a question to be addressed over a period of time. Probably, I don't know who will be discussing that in the conference at some stage, but definitely not me. So it's a long
But
term.
this is a major flashback to the fromage frere example in the US regulations, that goes into the entrepreneurial level of the entity, that is incurring the marketing expenses. And all of a sudden, it was like, oh my gosh, this is like fromage frere all over again. But I mean, but you touch upon something really relevant, that it's the whole picture. It's the whole picture. It's not just the cost allocation, or it's not just the activity. It is the whole picture. And I think that would mean that not only the Indian entity picture, but it is the global picture of how the IP is being used. Because if it's all controlled at headquarters abroad, but there's only in India an entity is doing something different, does that hold up? Can you actually drive home that it's different in India, even though globally it's all done in one particular way? So I think, and as an advisor, do you get that information, right? Because I mean, there's a cost to advice, there's a cost to this. Usually, a taxpayer comes in and says, I need this here and there, and so that's also something that we need to consider. Transfer pricing is becoming much bigger than just the local transaction that we're going to make sure it's arm's length and that's the end of it, right? Which is why the APA route is becoming so important, and the bilateral discussions are becoming so important. Yes. Just when the world seems to switch to risk assessment, I think we're all saying, no, hang on, we still need APAs, and we're very grateful for every government that's willing to move forward with that. So I think that's an important observation.
Yeah, so just to add, so the good thing is that the assessment, the TP audits have also moved towards looking at what the TNMM should be. So it remains a comparables dispute. It remains a quantum issue to some extent, but mostly I think companies are comfortable with a reasonable additional attribution for AMP. May not satisfy a purist of transfer pricing that your cost is being measured as value created.
Right.
It actually depends on the people who are driving decisions, but just because I have a person who's cutting a check doesn't mean higher intensity of function. The answer is no, but I think it's a good balance for us to deal with the issue. And that's how the APAs are also looking at it, to say, and that's the third example that Sir had, where you say higher TNMM for AMP function, and then you agree on that, and you just move forward. At least if it's a few basis points extra margin to be offered for an LRD, I think it's a good answer. But yeah, in practical real life, it's not easy to quantify. So I'm a company, I take no decisions, I spent 100 million, and he's a company who takes all the decisions and spends 100 million. How do I differentiate it? Today, 100 million is the measurement, and you give additional margin for 100 million. But the fact that we do different functions doesn't really get factored in, but I don't know how that will evolve in the courts. But it's difficult to pinpoint a number as to how I measure the value created by an individual when it comes to the TNMM analysis as of today. So just the cost-based adjustment seems like an easy way out.
Right. Now, even though we were talking about intangibles more broadly, we're constantly going down to the lowest part of it, which is the distributor, right? And the distributor margins.
So just want to cover that part. The hard to value intangible, again, is an important fact pattern for India. We are kind of the startup hub, 100,000
Yes.
startups.
Yes,
And the problem is that a lot of them want to immigrate outside.
yes.
And IPs are probably at an initial stage of development. Now, who determines its initial? I can't figure it out.
And it's all
They
exposed.
say that we don't know if it's going to be monetized or not, we want to move it. Today's value is X, and they move it, and then they get funding in 6 months, at 10 times of that value.
Yeah.
Now, what is right, what is wrong, there's no way to measure it. I think the only answer is APA, but the APA has to be a 6 months APA process where you say, this is my fact, tell me what to price, I'll price it. Now, if I get a funding after that, no questions asked.
Yeah, but would an APA officer actually be comfortable in closing off the HTVI post assessment, post fact assessment of value during the APA period? I think that would be a tough call.
Yeah, I agree. So, but the problem is, as advisors, we have no answer.
Right.
Because you don't know what is the behind the scene conversation happening. Maybe there is no value. Maybe the value will come tomorrow. Maybe the value is not in the intangibles, but in the promoters. So there are so many variables to the startup world that it's impossible to figure out where that actual value sits.
Yeah.
And you have to, and it's fair for the company also, because they also don't know what is going to hit them tomorrow. They may be expecting that the valuation may be X, but they might get 2X in the negotiation. So these are obviously variables. Now, when they thought that their reasonable assumption is X, and they pay tax on X, and then they move on, but then if they get a 2X valuation at some stage, which is not too far in the future, 6 months, 8 months, 9 months in the future, then how do you factor that in? That's the real problem we're going to come into, and we don't have an answer to that.
Right. Well, and let's, we're living in a digital world, and we've got the metaverse, and we've got AI that will be developing further intangibles, and who knows what the value is going there. So this discussion will be continued next year, I think, at the seminar. But Eric, you and I have been sort of like, going to and fro about, amount B, and Anushka already hinted at it, the amount B, this is the scope of amount B, and it's set up for pillar 1, but we don't know where pillar 1 is going, but we do like the discussion on amount B. We all sit up straight and we say like, well, wait a minute, if that actually becomes a safe harbor, even if it's for a limited group of distributors, although don't limit it too much, which right now the scope is getting smaller and smaller by the day, it looks. But if we would have a safe harbor there as to a return, I think you and I were going to and fro about this, that this may have potential, right?
Yes and no. I mean, potentially yes, because you kind of laying it out there saying, look, if you're falling in this bucket, you're good. But my own worry there is, coming back to TP being about subjectivity, does the safe harbor still remain subjective, right? In terms of how do you interpret the various classifications that are being brought about? Because ultimately, if all that is going to be part of the TP regulation, and how do you interpret some of those terms? So does that still pose a question? So does that really eliminate the need of analysis? What kind of analysis will be needed, right? How do you justify whether you fall in that bucket? So are we moving away from a kind of a comparability analysis, which is possibly no longer needed to justifying where do you actually land, which category you're going to fall under, right?
Right.
When you define the safe harbor.
Yeah. I remember a discussion way back when with Mary Bennett when she was still with the OECD, and I said, well, couldn't we develop safe harbors, for certain transactions? Because if you benchmark, if somebody asks me what does a distributor do, we'll say, well, they're between 2 and 6% operating profit, right? And I'll say, look, you have to benchmark, but chances are that's where can't we not do something like that? And she said at the time, she said like, no, because people will always plan into the safe harbor if they want it, and out of the safe harbor if they want it. And so, it just becomes, a total planning exercise and not a constructive exercise. On the other hand, if you look at the cost of benchmarking, if you look at the benchmark data, and if you would really dig into how questionable the value of the comparables is and the like, this is sort of the underbelly of transfer pricing, right? If you'd look at that, maybe we're not doing too bad if for certain, certain transaction, we would go to something like amount B.
I'd certainly hope so, but as I said, my worry is, does the debate move away from comparables to your classification, right? And whether you're falling in those brackets, and that's the larger worry that I have, as to how well are those categories defined? because those categories are not as well defined. And currently, what is out there, I'm not sure that's going to solve the problem that is there on the table.
So, okay, so we're not sure. So I'm still going to throw this at Shika and then at Rajat if he has some thoughts. And you know, we're still waiting to see if it actually will live to walk and talk. But Shika, do you have any, you know, warm or cold feelings towards what's being discussed on the Mount B?
Well, I would agree with Eric. I think it's really a scoping discussion as to what falls within its scope. And to me, based on what I've read, I think it's probably going to apply to a very minority of situations for Indian companies. And and Vijay talked about it. It all depends on the functional classifications and how well they're documented, how well they're done, which is a challenge by itself. Where are the people functions? Who's taking the risks? Does that entity have the capacity to control that risk? And I think that level of detailing to be able to prove that we fall within the scope of Mount B, that's going to be a challenge. And I think prima facie, it doesn't seem to me like it's really going to be a big game changer from the perspective of resolving a lot of the disputes. And we've had that experience in the past in India where safe harbors do exist for transfer pricing, not for distribution, but for certain other transactions. And we've noticed that they've not really helped, but that's less because of scoping, more because the benchmark rates were very high. So there's a different. So I look at this with some skepticism, the Amount B,
Right.
and its potential.
Right. Rajat, at the European Joint Transfer Pricing Forum, you know, way back when we came up with, you know, low value adding services, you know, we described low value adding service, and we said like the margin for those services should be, you know, anywhere between, you know, 5 and 10%, you know, and that means if you fall into that bucket of services, you don't have to do the extra effort of benchmarking them. You know, between 5 and 10%, we would think that is reasonable. If you want to go benchmark because you think it's more, or you want to go benchmark to show it's less, then go ahead. But technically, it would sort of be like a free ride because there are other things you can spend your time on. Alternatively, you could go get an APA. You could get an APA and decide on that those services are subject to. Which would you prefer? Do you see any benefit in a Amount B-ish safe harbor, you know, for certain functions like a distributor function, or would you say no? A government is always better off with an APA, and so let's stick with APAs. I'm really putting you on the spot for this.
No, that's all right. But see, I'm not dealing with Amount B.
No?
And it's not in my work area at present.
No, so you can hypothesize.
I'll not be in a position to comment on Amount B. Otherwise, in general, your question whether when there is a safe harbor recommended under the OECD commentary for LVAIS or any such thing, it could be beneficial in some ways, depends. And otherwise, APAs are always there to solve such questions. And any case.
Yeah.
So, Monique, we have a safe harbor for low value added services.
In the safe harbor, yes, we have.
Okay. So
we have legislated it.
In the changed safe harbor regime in 2017.
17 June.
I think there is a safe harbor for low value added services also.
Okay. So going back to
one more thing I'd like to add. Surprisingly, there are hardly any takers for safe harbors in India. And howsoever low we may make them, we are not finding any takers. So we are at our wits' end to figure out why there are no takers for safe harbor. In fact, I was collecting data recently to as to how many cases are there in safe harbor, and it's a low number. So really, I was yesterday discussing with one of the colleagues here, and my reaction was that it's kind of a showpiece which you must have in your drawing room, but probably its utility is to be adjudged separately, because there are no takers for small cases, which our safe harbor regime is like this only, that below 100 crore or below 200 crore, this is what we are offering, and then also there are no takers. So,
this sounds like a question to the audience. If I hear this, there's got to be somewhere in the audience who says this is why. Mukesh, I see that you are at least already. Are there others in the audience that want to answer this question? And maybe you want to, but you don't dare to, but just go ahead. We don't ask for your name, you can just ask. Okay, then Mukesh, please. This is a perfect question. Thank you for bringing that up, Rajat. I think we need a microphone we need a microphone in the audience, please. Sorry about that last minute change of plans here. There we go. Because yeah, you would, well, I mean, maybe this is Mary Bennett's point. Like, you know, if you have a safe harbor, people will use it only if they benefit from it, and maybe they think they don't benefit.
I have a couple of questions for Vijay, but before that, let me answer Mr. Bansal's question. He's right, there are no takers for safe harbor. And the simple reason is that the limits are very high. I think he should take the benefit of many people on the panel. They will probably guide him on what the right limits are. Because my philosophy is very simple. Keep the limits at a lower such that you have more takers. They pay more taxes rather than disputing it. I think eventually it's a benefit for the treasury. So I just, sorry,
Okay, so
at
there-
this
so
cost of indulgence, I was there in the first committee of Safe Harbor, and I know the.
Benji, I'll
this-
just come back on this. One reason we thought was that probably the monetary threshold for, at least in case of ITES and software development cases, maybe the monetary threshold is what is hindering this. But we discovered that the limit fixed is covering almost large majority of cases, and still there are no takers. So your view is that the margins offered under safe harbor are still too high. I don't think so. There would be some risk premium for obviously a certainty, a little bit, but I find that at those levels, other matters are getting settled. So here also, difference is not that much.
I'm coming more from a disputes lawyer standpoint. Many clients say that it's not worth litigating in India. Let's settle it, but the limits are high. Also, on Vijay's point on intensity for marketing intangibles, maybe we should consider safe harbor for marketing intangibles as well. A lot of disputes will get settled. I have two questions, Vijay, for you. You mentioned about this example of $100 million spent, and you pointed out to Eric saying, I'm a low value, low risk, and he is high risk. How do I determine that? I don't know whether FAR will capture that, and even if it captures it, whether the tax administration will accept it at the assessment level, and if there are any suggestions you have based on your studies. Secondly, you mentioned about the startup ecosystem. I think there's a very easy way out for HTVI in a startup system. The startup system in India is now accompanying the startup financing system. There is Series A, Series B round of funding, private equity, IPO. So as the valuations go up and these companies become unicorn and multi-unicorn, isn't that a basis for you to look into the HTVI valuation? Your thoughts?
So on the first one, I think from a TP study point of view, the FAR will capture the quantification of that. What is the economic value of that difference in function is where I think the challenge is, because you don't find any comparables to make that differentiation. So I think we have just used cost as the measure, but the service element or the employee cost or the employee contributing to IP is an important aspect. And the other part is that when I look at the tested party P&L, I have employee cost as a line item, which has 500 employees all merged into one number. And then I look at a comparable P&L, it also says employee cost, 400 employees or whatever with a value. So I don't know how much of intensity does the comparable have. Our assumption is the comparable should always have highest intensity because they are a risk-bearing, full entrepreneur company, so they will be highest intensity. So I should be pegged lower than that for sure. So I don't need to make a further adjustment to TNMM to factor the difference in intensity. So the cost of AMP should not be a factor at all. The difference in intensity is already happening because of, so even if I go up the value chain, I'm still comparable to a third party comparable who has the whole hog of functions and risks in their business. So my view is that we take away intensity completely. That's an argument for the court. At the assessment level, it's still cost-based and you kind of settle somewhere. On the hard to value intangible, if you have a reference point of a valuation, it's easier. The problem is you have either there is no reference point because the company has not gone through a funding, or if it has gone through one level of funding and the second level comes in very soon, that interim period is also very sensitive in a real life. Now, how do you quantify that and what has changed? And you move out and then the second round comes at a much higher valuation. Was it an incorrect transfer pricing in the first place? Was it a best judgment at that stage? I think those are really tricky questions. And I don't know if legislation can solve it, but some kind of a agreement is the right answer, is the way I look at it.
And just to add, and I think part of it you captured earlier when you were speaking. I mean, the way I see it is, what is the intangible, right? I think there's always that question as to what is really the intangible which is getting transferred out. Because the intangible could be just the formula or the code which has been written, which is what is really garnering the attention as far as that startup is concerned. And as you rightly said, the human capital element to it as well, right? How much of it is so much about the promoter and the thought process and the business ideas. And mind you, I mean, businesses are dynamic. They will have to keep pivoting depending on where they are. So even in 3 months, if as a businessman I take a different decision 3 months down the line, which completely changes the face of what my company is standing for, that can change the valuation as well, right? So what is the intangible? Can there be more than one intangible? And also that point of time, I don't think can be static. So even 3 months, according to me, did not necessarily mean that that is what the value of that IP is.
You know, I totally agree with that volatility. You know, it's an unpredictable situation. And I think we've witnessed that very much with the COVID years, where you know some values went up tremendously because people switched behavior overnight, and some values dropped dramatically because they weren't being used, and entire business concepts fell to pieces that were carefully crafted and had humongous investments. So I think that is really the purpose of this discussion, to point out that intangibles, you know, yes, they're valuable, yes, they're important, yes, they need to be carefully studied and monitored and safeguarded from a competition perspective and from an operation perspective. But there's this additional level of tax exposure, which can be really detrimentally high. You know, if we see in the Coca-Cola case, I mean, if we see the adjustments that you can run into, and you can have all kind of comments about, you know, should you have adjusted that, change that closing agreement to extend it for later years. And I mean, and there's all these discussions. But separate apart from that, the exposure to basically the life of a business that intangibles can bring from a tax perspective, separate apart from a business and competition perspective, is staggering. And that is why I think we wanted to put it forward in this particular panel, that from a transfer pricing perspective, you really need to sit down and look at the whole picture of the intangible. And India, at least, has been very outgoing and straightforward about its position. Now, whether you agree or not is a totally different thing. But, you know, and the courts have come forward with, you know, positions on this. But you really need to do your homework here. And I think it's a very good sign that from an APA perspective, we're seeing progress in addressing this, because there's still a lot of governments that still, you know, hesitate in taking reasonable positions in this field. With that, I'm going to ask for last comments, last statements, well, we didn't discuss this. We really have a few minutes left. Starting with you, Shika. Anything that you want to bring to the audience from an Indian practice perspective?
Yeah, I think one of the things that is really important, and I think you mentioned it very briefly, is that when we're looking at APAs, I think for multinational groups, a bilateral APA makes much more sense, because you did mention that typically groups like to have a single royalty rate that they're charging to various constituents of the group.
It's 13% everywhere, yeah.
And let's say India has maybe, you know, we've seen certain countries where, because of foreign exchange constraints or because of taxation constraints, paying beyond a certain rate is challenging. And therefore, the group then ends up with certain constituents not really paying the standard rate. And in a unilateral APA, even if that non-standard rate is agreed between the taxpayer and the local authorities, it can create troubles for the group in other jurisdictions that are actually paying the standard rate, to say, why should they then pay standard rates? And those the governments in those countries would then question that, if certain, because it's all now disclosed in the master file. And then Vijay's point on if there can be 6-month APAs, which is
We've had one.
the wish list for the next millennium. But I think that's an important part. The bilateral APA process is our only hope right now, and that needs to really, give people faster, more cognizant of the practical realities, and that's where at least I would stop.
Yeah. And Anushka, you have much more of a global view. You look at what globally is happening in this area, and you basically discuss trends. What would you want to bring to the table, listening to the discussion and what we are trying to grasp?
Well, there's no one size fits all. So depending on which country and which tax administration you're dealing with, you actually need to look at the transaction involved and build your strategy on that.
Yeah.
Because some tax authorities have like very particular views on, say, the treatment of transfer pricing and intangible transactions. So you actually want to keep that in mind.
Yeah. So you're saying, like, you have to go back to the local situation. Although we see a lot of governments learning from other governments, right? In jurisprudence, Rajat, is that something that you observe? That does the Indian revenue, as far as follow what decisions on intangibles in foreign jurisdictions are? Is that relevant at all, or is it really just a local analysis?
Again, the answer would be yes and no. At least the courts are taking cognizance of the
Of course.
foreign decisions.
Of course.
And in Sony case, they did discuss DHL case, and also
Of course.
I think one more case I'm forgetting. About the otherwise, I'll say that if there could be minimization of the areas of where differences are there between the taxpayer and the tax administration, maybe then the solution could be easier. For example, this international existence of an international tax transaction issue, even if it is the question before the highest court, I think there, if you read the Sony Ericsson decision or other decisions, it's, to me, at least personally, it appears to be not a very significant issue. But still, we are litigating on that first and are not able to move ahead. So probably if there can be convergence on some issues, and that's what I said, minimize the issues of where difference lies, not only under an APA system, but also otherwise, then probably the dispute will get resolved faster. This is purely my personal view, but I think this could be one way. And secondly, one more very different aspect from moving from today's discussion. There is a provision for APAs in respect of profit attribution to the permanent establishments in India, and there was a discussion yesterday in I think 2-3 sessions about profit attribution to PEs. So from the point of view of tax certainty, that's a good provision, and if there are certain APs already concluded on that.
Okay, so that's progressive. That's good. Eric, I'm going to go to you first before I come to Vijay. From this discussion, what do you want to bring to the audience on India-specific practices?
Well, firstly, on a lighter note, given the amount of interpretation and disputes, we all have good jobs for a while, so that's the good part. But on a serious note, I think the basic tenets and principles of transfer pricing will apply. Substance in terms of what is there economically versus what is really there in terms of documentation. Time and again, not only have us as consultants reiterated that, but the courts in some form or the other have kind of continued to focus on that, saying, look, it's ultimately going to be what you really act on the ground, right? And the Coca-Cola decision is a classic example where they went on to particularly say, what will be interesting is to see how on the other side, right, once a particular court rules on a particular fact pattern, so to speak, will the other country also take cognizance of the findings there and try and kind of accept that? To me, that's going to be a vexed matter going forward.
Well, that's a valid point. Well, Vijay, for you, the toughest job to render advice on, what should one do in the field of intangibles operating in India, and what should one consider? What is the key thing that you should consider when you?
So I think COVID has created a problem of distributed Dempe, because now we can have people working anywhere and doing Dempe functions or CXO roles. And this is a big problem. And our clients are still in the traditional mode, because they still say that, no, but this has been working for the last 10 years, but it's not the same. So I think things are evolving very fast. And what is the impact of distributed Dempe will be a problem that all of us will encounter. Unfortunately, we've had to push back some of these movements into India, and some of those centers got set up in Singapore, but people wanted to move out of various overseas locations and come closer home, but they had to make a choice. So that's a problem statement. At some stage, I think we'll have to address it as a country to attract the talent and not create Dempe and not create profit split positions and things. So that's one problem. People function remains an important part. Again, the traditional way of looking at transfer pricing will not work. So it has to get more attention at the CXO level. So people have to be cognizant that when they are doing hiring decisions, when they are looking at overseas expansions, the traditional TP planning doesn't work. So you can't just have a box entity, which everyone understands now. But you can't also have people doing various roles in these countries and not take cognizance of that in your TP model. So TP and business go hand in hand, and we have to be cognizant of that.
Yeah, but I mean, with the internet, we'll be buying things online. That gets us back to pillar one and why amount B is there to begin with. So there's a lot coming your way. Please thank me, put your hands together to thank the panel for, I would say, help me thanking the panel for their amazing contribution. Interesting, we had many other examples we wanted to bring up, but we'll save those for next time. But thank you so much for an interesting discussion. Thank you.